AI is coming for the lunch of some of these companies. Their business models are not, we're not just talking about cyclical turnover. We're talking about, a business model that becomes obsolete structurally. That's one risk. And then, of course, there are questions around AI specifically, how much of that is really going to pan out in terms of, investment resulting in the sorts of things that are being priced in. So absolutely those things are connected.
The reason why I ask, and this is sort of the systemic node that some people who I'm speaking with are talking about right now, the reason why markets are feeling good is because capital markets are wide open. People want to invest, they want to finance the AI revolution. What could cause people to pull back? Because that would be the ultimate lever that would create a real problem. Do you see any sign of that whatsoever?
There could be certainly a massive miss on the part of one of the hyperscalers. I think the thing to watch, and the reason this tremendous expansion in the hyperscalers and their capex expenditure hasn't really been an issue is because it's been cash finance pretty much entirely. We're just now starting to see them resort and lean into the credit markets for financing and issue bonds and debt to finance it, but it's still such a tiny portion of their capital structure overall. And where it's growing, like Oracle, for example, we're seeing the effects of that in there, CCS, et cetera. And so I think that's really the thing to watch is how much debt and at what pace will they start accumulating it to kind of say, okay, maybe there's a red flag here, maybe not.
2 weeks away, Microsoft, April 29th. I think Meta's April 30th, and we'll look out for Alphabet as well, of course. Are we going to see that discipline kick in? Are they going to have to pull back on capex? They've said 1 million times in several different ways that the biggest risk for them is underinvesting and not over-investing. But it was easier to say that when the equity market was ripping and stocks were at all-time highs, and they were a big part of that story, particularly the likes of Microsoft. I wonder how hard it is to make that statement now, this morning.
And I think that the lead up to it is going to be all the companies reporting earnings ahead of it. How do they express the efficiencies? How much are they getting disrupted? And if they're not getting disrupted, then how does big tech justify all the investment that is only accelerating year after year in some of the technology?
Nasdaq futures down by 0.6% this morning. Oksana, good to see you.
Thank you.
Thank you for being here. Jim Souter of the Hollow might say, take a walk or something like that.
Well,
he didn't say that. Say, take a walk to get some fresh in.
I'm for it. I'll do Pilates.
Bring it down, just a touch. We'll start the show later so we can all go and work out. We'll do Pilates and come in much more fast.
I think it's so fun.
Oksana, thank you. Oksana Aronoff there of JP Morgan. Coming up on the programme, Steve Rashuta of Mizuho as hopes of a Fed rate cut this year are fading. Plus, we'll catch up with Christina Kino. She's got your morning movers. Shares of Goldman Sachs falling as earnings failed to impress. That name is down by more than 4% this morning. That kicks off earnings season on Wall Street tomorrow. We'll hear from JP Morgan and others from New York. You're watching Bloomberg TV.
back into AI adjacent trades. So the secular kind of CapEx story reasserted itself, even though now it's going to be more costly. There's more logistical implementation problems because of higher diesel costs and higher energy costs. So all of that now is more questioned about the profitability of getting AI to the next level of this cycle. So I hear you guys. I'm a little doubtful. I think we have now lost 2 million barrels. Alex just said that's actually even tighter now for Asia. Now we saw exports out of basically Taiwan and Singapore all going through the roof in Q1. So this has yet to really hit the real data. But looking forward, we're going to have to think about this a little differently. And that's where we are now.
I just want to point out that Madonna did not write that song.
Okay.
You're referencing John Bon Jovi
Oh, sorry.
from 1982.
Related song.
Yeah.
Like a prayer.
Like a prayer. That's what it is.
Yeah.
My bad. Yeah, it's been one of these mornings where my head's a little scrambled still, and the weekend was busy, as you guys know.
I totally understand that. But why do we see, markets not reacting to any of this negative news in terms of stocks? We're still near all-time highs. In terms of oil, we're off all-time high, at least for non-dated contracts. And then in terms of yields, we're floating up, but still at 433 on the 10-year. We're still stuck in ranges here.
Yeah. I mean, again, the price part came down, the earnings part has gone up. So the valuations now look more attractive. And that's what Morgan Stanley and JP Morgan are telling us. And the US is more insulated. That story is really gaining traction, right? So now all the rotation we saw into Europe and EM potentially slows or comes back out into the more insulated American stock market that has a better AI secular story to latch onto now at better entry levels.
All right, insulated in terms of the AI is a big, CapEx is a big driver here, but we're not really insulated on the oil part, right? Because if they can't get oil out of the strait, they're coming here to buy it from us and bidding the price up.
Yes, and that's exactly what's happening. So you've seen the sort of logistics of the oil markets completely changing underneath. And that's why actually like on delivery now is at about $140 a barrel, not this 110 or 100 level that we're seeing in the front. So what's actually happening in spot is much tighter. When we think about products, that's got even crazier because getting jet fuel, getting diesel, getting propane, all these things are becoming much worse. And Asia's had to shut in. So actual activity now, whether it's people turning ferries and buses off or the factory starting to close is really occurring. And as we know, that will affect global earnings. And we are not insulated from that with about 40% of the US earnings coming from abroad.
Also only just now starting to face the reality of higher oil because it takes time for these tankers to get out. And everything that's been delivered to this point has been the pre-war oil price. Presumably, like just right now is when you're starting to get oil come out that is actually priced at these levels.
Now, by the way, everyone's been pulling levers to blunt the surge of costs, right? So you've had, as Alice was just saying, we took sanctions off of Iranian oil, which is insane. We took sanctions off of Russian oil, which makes a lot more sense. You have the Europeans who are lowering taxes on energy. Everyone's trying to blunt that surge in costs. And so it's going to hit maybe harder like a coiled spring when it actually happens.
Absolutely. And finally, some of the last shipments that got out before the strait really closed are hitting the ports now. So to your point, that's absolutely happening. Also, inventories now are changing. If you're a government, you are okay drawing down inventories. But now because of defensive needs or national security concerns, you have to be a little bit more concerned if this lasts longer. So this is no longer sort of this temporary shock positioning. Now we have to take longer term plans, which means much more curtailment, which means less real economic activity.
All right, Michael, great to have you here on the desk with us. Really appreciate your contributions. Michael Ball from the MLive team. He writes about stocks and bonds and less about 80s rock.
completely mad.
Where the money flows, which buckets are changing.
Conversations with players shaping the narrative. Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is open interest.
Only on Bloomberg.
Is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace. Do you feel pressure? Massive pressure.
Is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard, oh boy, can you imagine Ferrari without racing?
No, and I say no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'd still be driving something.
Probably very fast.
This season, we're along for the ride.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Jennifer Zapasaglia in the Lesotho Highlands, and this is Bloomberg.
When news breaks,
The redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
Let's get to high interest now. Look what's making headlines around the world. Hungary's new leader, Peter Magyar, is moving quickly after a landslide win over Prime Minister Viktor Orban, who had backing from both President Trump and Russian President Vladimir Putin. Magyar now pledges to restore the rule of law, unlock frozen EU funds, improve ties with Ukraine, and bring Hungary back into the European mainstream. Pope Leo XIV is doubling down on condemnation of the Iran war, urging peace and dialogue despite sharp attacks from President Trump. The clash began on Friday when the Pope posted, "God does not bless conflict," slamming the U.S. war with Iran and Defense Secretary Pete Hegseth. Trump fired back, saying he doesn't want a Pope okay with Iran getting nuclear weapons, then escalated further, posting an image of himself as a Christ-like figure healing a sick man. It's not Jeffrey Epstein, although a lot of people have said, is that Jeffrey Epstein? Wall Street's biggest banks are set to post a record $18 billion in stock trading revenue for the first quarter, driven by the Iran war and rising anxiety over AI's economic impacts. As earnings season begins, investors are watching for executive commentary on tensions in the Middle East, as well as private credit and AI.
And we got the early look this morning after Goldman Sachs reporting at 7:30 a.m. It was a record quarter for equity trading. The fixed income, that disappointed. Joining us now for more on these results is KBW Head of U.S. Bank Research, Chris McGrady. Chris, shares down somewhat sharply this morning. What did you make of the results from Goldman?
Hey, good morning. Thanks for having me back. Results were good, right? The top line beat. Revenues were stronger. M&A was up sharply year on year. Trading results were a little mixed. And so with the stock at 15 times earnings and 2.7 times tangible book, it does come down to expectation. So I think some of the weakness this morning is related to the quarter, and some of it is the macro.
So we teased, you would tell investors where to put their money. In banks, Chris, what are your best bets right now, even knowing that we still have a lot of earnings to come out?
We still think the bigger banks are the place to be. We've been big on Citigroup. We like Citigroup not only for the quarter. We think the May 7 Investor Day is a really pivotal moment for the company's evolution. Right? We think this year the ROE of 10 to 11% is going to be achieved, and we think how they lay that out next month and that path towards the medium to longer term return on equity is going to be really important. And that stock trades at a little over tangible book today and below forward tangible. So Citi's one of our top picks.
I do just wonder, Chris, we're going to hear from David Solomon and the rest of Goldman Sachs in just over 10 minutes time when they have their earnings call. But from the commentary we got so far in their earnings release, Solomon said the geopolitical landscape remains very World's most powerful investors don't ring a bell. Fake quiet.
Headwinds from rising fuel prices and a pullback in the spending due to rising fuel prices. So inflation may be hurting them. You can see Carnival, Oil, Caribbean, American, and United all down, but really across the board, travel stocks getting hit today. RBC head of U.S. equity strategy, Lori Calvasina, says earnings will give crucial insight or in the Middle East will ultimately impact the US economy. She writes that if the fundamental narrative around the war, its impacts changes, there is room from a valuation perspective for stocks to fall again, perhaps even more than they did before. RBC maintains its price target, though, on the S&P 77.50, which is pretty funky considering the war in the Middle East and a doubling of crude prices in a couple of months. Lori Caldesina joins us on set now. It's pretty crazy that we can still, go back to and you think even beat all-time highs as we
welcome to the open and home sale.
750 target. We do our price target a little bit differently than most people. It's not a December 31st 12-month forward look, and we update it monthly. And we're very strict with the numbers. Even that, I took my valuation model, which produces a fair value estimate of 77.59, and put in some pretty onerous assumptions. I cut the bottom-up consensus for earnings over that time period by 5%, just a haircut, just kind of an arbitrary haircut. I also, for the PE assumption, baked in 3.3% inflation, a Fed that does nothing, and 10-year yields of 4.5%. So I can still make the math work. Even within that assumption, though, we are looking for a market that, if it is going to climb higher, has to be on the backs of a solid economy and a solid earnings backdrop that can take some damage from what's going on in the Middle East, but not too much. Obviously, we're kind of walking along a razor's edge, but that is what the math is telling us right now.
It's also a market that really has not, at least for equities, experienced much stress. We didn't get anything close to a 10% drop, maybe around 7%, which is good up to 10, but we didn't get a correction. I was reading through my Folsom and Morgan Stanley's call, basically saying, buy any dip, and I was looking what was the dip, and his sort of thesis is that there was one. You had more than half of Russell 3000 stocks that were down at least 20%. Earnings multiples fell 18% from the October peak. So, Lori, was that us pricing it into the market?
So on our calculations, if you look from the late January high on the S&P to the low we had in March, it was a 9.1% drop. That's within what we call a tier 1 garden variety pullback. We characterize a growth scare as 14 to 20%. We've had 5 of those since the financial crisis, 2010, 2011, 15, 16, 18, and 2025. While my target, I think, is pretty similar to Mike's, I would respectfully disagree with him on the idea that we hit a hold your nose and buy moment from either a valuation or a sentiment perspective. Now, we do think that the froth came out of the market on both of those, which permitted, when the narrative changed on the war, to allow stocks to move higher. That is very different, though, from saying things were washed out. Russell 2000 is my old stomping ground. I spent 7 years, I think it was, maybe more, I've lost count at this point, where that was all I did on a day-to-day basis. So we watch the Russell 2000 valuations very, very closely because they are a good washout barometer. And what we have seen since the financial crisis is that you hit 11 to 13 times, even last year, even if you go back to 2023, even if you go back to 2022. In fact, each of those last 3, we hit, I think, like 12.2, 12.5, 12.6 times on the Russell PE. That is recession territory. What we did this time around was not even looked at. It was 14.7. And while if you look at a similar analysis on the S&P 500, we hit the tariff lows. We did not hit the lows of COVID. We did not hit the lows of 2018. We did not hit the lows of 2022. So we disagree.
Why is that, Lori? I get your disagreement and you make a strong argument. Yeah. Maybe Mike will come on here and push back. But why is it that we're increasingly sanguine when it comes to geopolitical problems? I mean, I get that COVID maybe was a much bigger, but this is still a war in the Middle East, the closure of the Straits of Hormuz. At least some arguing that we're angering a nuclear capable eventually power. So it sounds very, very bad. And yet, to Danny's point, we didn't even come down 10%. Oil doubled, but it didn't get back to its highs of the great financial crisis. It doesn't feel that rough.
So we did a survey of our analysts a couple days after the war started, and we asked them to assess the earnings impact from higher oil, the Middle East revenue exposure directly, and then the knock-on effects from the crisis. And what we found was that risk was identified in consumer staples, to some extent in consumer discretionary, and then the materials sector. And what we saw for most of the other sectors was our analysts were saying, if this was a relatively short duration conflict, and we don't know exactly what short duration is, right? We're hearing companies seeing the same thing, but we don't know, is that another month? Is that another week?
We're going to get color on that in this reporting season, but generally,
It's important to note on this program, especially, that we don't know what that means. There's no Webster's definition for short
well,
duration.
look, analysts have to go out and ask these questions on earnings call. The financial journalism community has to ask CEOs these questions. Are we talking about a month? Are we talking about 3 months? I have seen some companies in the commentary we've read refer to the idea of 1 to 2 quarters, 3 to 6 months. I can count them on 2 hands. So it's certainly not everybody, but those are the breadcrumbs I've been able to pick up. But what we did see from our survey work, and we've been hearing from the company commentary, that there's a certain window this thing can get done within, and it's not going to really damage earnings all that much. Now, we don't know exactly what that window is. And to be fair, a lot of companies have not really been hit with direct impacts yet. So that tune may change once they actually start to get into the soup.
We did ask Danny a congressman once, remember?
Yes. So he's referring to, I asked what short term actually means, and he told me to look it up in the dictionary. But short term can have a different meaning. And to your point, what it means for companies is so different. But Lori, I mean, companies have to know. I was having this discussion with someone over the weekend. This idea that the oil that's been shipped out that is now reaching shores has until this point had been pre-crisis levels. Now we're finally getting barrels of oil on the market that are priced at, the $140 coming through the Strait of Hormuz. So when companies report earnings, will they actually have any of the evidence of energy stress? And if they don't, will they hint towards more to come? Or do they want to kind of reserve that for when they see actual impact?
So what we know is that companies have also been referring to the idea that just like the analyst community, they're running their stress tests, they're doing their scenarios, they're looking into their supply chain. So hopefully they will be able to give us better answers. I do look back to the tariff episode of last year when it felt like people were a little too conservative out of the gate, and then had to kind of go and walk back some of those downgrades to forecasts later on. Perhaps that's going to make companies a little more reticent to kitchen sink things this time around. I think that's fair. I do think that we are in a little bit of a discovery process with where you have to go. But the key thing, going back to the commentary on, are you washed out? What evaluations look like? The difference between what we just went through with that 9.1% drop and some of these other places where we've gone deeper in the past to deeper valuation levels, people have genuinely been concerned and scared, I would say, about a recession coming around the bend. And we never got that, right, in this 9% drawdown that we have. We could still get it. And then I would argue markets do have another step function down. But right now, it's an elevated risk. It's uncomfortably high. It's not really the base case at this point. So we do think stocks can stay on that path. Is our confidence super high? Not as high as we would like.
Hey, Lori, just a quick question. Matt and I have continued to be fascinated by market positioning in all of this. And it feels like whenever we get risk on and there's more stress in the market, software stocks go up. And then whenever we get some sort of resolution, or it looks like a little bit more peace to come, software stocks go down. How much of this is just jockeying back and forth between hedge funds shorting and covering those shorts? I'm looking at IGV. It's up 1% this morning.
I feel like I don't really know any big bulls fundamentally on the software space. When I look at my valuation work, we tend to look at it both on an absolute basis, just the Russell 3000 group. And it's hit some interesting lows. And if you look at it relative to semis, it hit some interesting lows where I get a little, yeah, I think you can say some people are making that argument, but where I push back just a little bit on it is that software has seen just the evaporation of its upward revisions, but hasn't really had a downward revision cycle. So if you want to kind of hold your nose and buy an industry, we like to see them washed out on earnings revisions and valuation. You're getting one, but not the other. So I'm not going to fight with people on this one, but it's not quite where I would want to be to kind of make that call. I do think generally though, when we're in this tier one pullback kind of drawdown, that people are playing safety through tech, through longer term secular growth. And obviously that thesis has been challenged here, but a lot of people do also do this stuff through ETFs, right? Or the broad market does have a decent amount of
Again, up 1% this morning in a market that's overall down. Lori, thank you so much for joining. We're just out of time. Lori Calvasina, RBC head of U.S. equity strategy. And let's get a check on your equity market. You'll see that in some of the biggest gainers, that there are a lot of software stocks that are at the top of the pile. Intel, by the way, if you go over there, has been on a 9-day winning streak. Make this number 10. It's already added $100 billion in market cap. Again, what is it? Is it short covering? Is it good news? Is it just momentum? Either way, again, you see a lot of chip makers doing well. Lam Research, for example, Broadcom, Marvell. So a really good day for a lot of tech-related companies in the chip making space. Not good for the mega cap tech. NVIDIA is down. I guess some other semis are down too. I don't know. It's a strange market today. Micron down NXP is down. Analog is also down. Okay, so the semis are down, and then some of the other software companies are up. If you look at the breakdown of the overall index, no surprise, energy is up alongside the price of oil, which is surging more than 7% this morning. At the bottom of the pile, consumer discretionary financials, that's being dragged down by Goldman Sachs earnings. That sector down by 0.6% of that.
You know what? We're going to continue to talk about Goldman Sachs earnings because, as you mentioned, the conference call kicking off, fixed income trading suffers as equity trading soars. Our Bloomberg Intelligence senior bank analyst joins us next on that. This is Bloomberg Open Interest.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back in another season of The Duty with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
One in history in sports, not two. And it's because that team with imagination, that team was putting yourself in a way, having yourself hit the hand now.
Erica Ayers Badon.
My high energy. I'm very passionate. I have a lot of it.
Up in our zone.
I like fires and flies. That is still one of my core mandates with all of my businesses.
Justin Tuck.
Tell all of my friends that play the leagues now, make these relationships now while you're hot. Don't wait till you're like 12th year in and you're just hanging on.
Looking to short NASDAQ here.
Welcome to Bloomberg This Weekend. I'm David Burrell.
I'm Lisa Mateo. I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. Sector is really propelling the field forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday. Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Guys, buckle up. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with the close. Weekdays on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jemana Versecki. Join me on Bloomberg Horizons Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
High levels of volatility. There's still room to maneuver. Here's the opportunities that allow you to increase significantly your net income.
Every trading day, only on Bloomberg.
Yeah. 15 minutes into your trading day. Let's get some top calls. The analyst action we're watching. First up, Bank of America. They've cut NXP Semiconductors. They say growth looks limited. No real AI angle, weak EV exposure, and over reliance on phones. Those shares down 2%. Next up, Goldman Sachs is turning bearish on Best Buy. Getting double downgrade, it's now at a sell. The firm says that higher memory costs are about to make laptops and computers pricier after the first quarter. That could squeeze margins as truckers off for less expensive models. Here's down 2.8%. Finally, Oppenheimer, they've upgraded Blackstone, saying that the firm is a high-quality company, now trading at a relatively cheap level, and sees current dislocation in shares as an opportunity for investors. Shares up 1.3% now.
All right, now Goldman Sachs equity traders, as we've been telling you, beat their own quarterly revenue record by more than $1 billion and made a new Guinness Book of World Records record for equity revenue of $5.33 billion in a quarter. But shares are down as bond traders missed expectations. Bring in Bloomberg Intelligence senior U.S. bank analyst Herman Chang here with us at the desk. So Herman, fixed income trading revenue as well as currencies and commodities missed by, I feel like, a lot, $800 million, Street's estimate, and down 10% on the same quarter last year. Why?
Right. So heading into the quarter, the increased volatility that we saw in March was expected to lift results for trading, especially in FICC across the group. So you can point to the fact that JP Morgan and Citi were expecting trading revenue to be up 15% this quarter, year over year. And then Goldman comes out and misses. So that's the reason why I think a lot of folks got caught off guard because
when you see a big miss like that, do you and Allison Williams and Neil Sipes, do you all redo your estimates for the banks coming out tomorrow and Wednesday and Thursday?
It does put a bit more of a damper on expectations going forward. We'll see tomorrow if Goldman was more of an outlier or if this was more of something more systemic across the group for the quarter. But right now we're just in a wait and see mode because, again, this was such a surprise for the entire group.
Everything else looked very strong. I wonder if, in terms of trying to decide.
Got some stuck sellers.
If it has
Stuck.
also Solomon's comments.
Got in the micro scalp. It's rotating, trying to rotate back up.
It's a little bit weaker than it was at this time last year. It's such a strong
Sellers just stuck.
stresses.
Right.
Go to sellers trap right there.
And also
Look at these sellers.
Pipeline as well, because we're heading into the year expecting strong M&A activity, and the comments today sort of
has broken, has taken buy side liquidity.
Through the volatility, as long as it's good volatility, we saw some bad volatility from Goldman this past quarter, though. So it really remains to be seen how things flesh out going forward.
All right, Herman, thanks so much for joining us. Bloomberg Intelligence senior U.S. banks analyst Herman Chan. And you can follow our coverage of Goldman Sachs earnings on your Bloomberg terminal. Just type PLIV Go. You can follow Herman's work and the work of his colleagues by typing BI Go on your terminal. Or if you're in an individual equity, I type BICO to see who's covering that stock. Coming up, the blockade deadline at 10 a.m. Eastern, just 11 minutes from now.
But at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil. And that will be very effective.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at criminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here where the action starts in Sydney and in Tokyo. Get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemima Versace in Beirut, and this is Bloomberg.
President Trump's blockade deadline approaches in just 7 minutes' time, 10 a.m. Eastern. Bloomberg opinion columnist Mark Champion warning that the strategy could backfire. Quote, the blockade itself is a throwdown the U.S. can't win. He joins us now. Mark.
Now buyers are stuck. It was a manipulation.
Obviously, we'll see what happens.
Gold wants to come back down.
I am skeptical that this can really work.
Let me see.
You know, it is extraordinary that, you know, during this war, we've got about almost 7 weeks of it now. You know, Iran has been able to close the strait to other countries, tankers and exports, but has been able to get its own out. That has resulted between that and the U.S. easing of sanctions in order to try and keep a cap on crude oil prices. That has resulted in a really large windfall for the Iranian state in the midst of the war. So this obviously is designed to kind of close that loophole and to put pressure on the Iranians so that they'll come back to the negotiating table and make more concessions. The reason I'm skeptical is simply that the Iranians have shown from the very start that they have a much higher pain threshold than either President Trump, the US, or the global economy. And so, you know, the bottom line is we're simply, we're actually, you know, furthering the closure of the strait. There will be less oil on the market. Prices presumably will go up. And then it's a waiting game. And it's just a question of who can wait longer. Right. Nouriel Roubini says it's a game of chicken that Iran will win. I got to ask about the nuclear side of things, Mark, because I hear conflicting messages out of, you know, Mike Turner, for example, was on Face the Nation with Margaret Brennan yesterday, and she was asking
Looks bullish.
moves, and he was
At least Nasdaq looks bullish for sure.
nuclear. They can't have a nuclear weapon. But President Trump told us last year he'd obliterated completely and totally their nuclear capabilities, which is believable when you look at the B-2 bomber strikes on Fordo, where that highly enriched uranium was supposed to be. And he continues, the president, in the last month to say it's only nuclear dust. He continues to say it's buried under rubble that you just can't get to. Like, if they don't have the uranium or the tools to enrich it, why are we so worried about them getting a nuclear weapon? You know, that's a good question. I think there's several parts to it. The most simple is that in order to get, you know, make sense of the war and the costs that it has incurred, you know, we had nuclear negotiations going on just before the war, and you know, they were making some kind of progress. But what the U.S. said was, we need a complete ceasing of all uranium enrichment, an end to the program. So really what the U.S. needs in order to say that this war made any sense is for the Iranians to say, okay, we will back down now, and we will have no program. The Iranians haven't done that. As to where, you know, why we're afraid.
Nasdaq looks bullish. Gold is bearish.
Weapon itself. A lot of the stuff that has been said about, you know, just 2 weeks away, we have to hit, and that's it. It is nonsense. They are, you know, the last attacks in June, they set back any program that the Iranians had by a long way, but they still have heavily enriched uranium in some quantities somewhere buried, and they have the knowledge to rebuild what was destroyed. So in time, they can do it. Mark, great to get your take. Thanks so much for joining us. Mark Champion writes for Bloomberg Opinion. If you've got a terminal in front of you, you can type OPIN GO to see all of Bloomberg Opinion's stories. Coming up in the next hour, Ethan Devitt tells us if he would buy the dip, what little dip there is. Plus, the CEO of Slate Auto talks about a $20,000 pickup truck. This is Bloomberg. Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the products?
Can you just move your
Yeah.
supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into.
Sneeze.
For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
From global politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Home sales down.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Danny Berger, and despite oil spiking, a blockade just starting on the Strait of Hormuz, we've turned around, and we're now in the green for equity markets.
March was 4.09.
Green. It's only 0.04% for the S&P, but it's up. This hour, President Trump moves to block the Strait of Hormuz after peace talks reportedly collapsed over the weekend.
And oil surges back above $100 per barrel as Trump's blockade threat deepens the global energy supply shock.
Plus, Goldman Sachs kicks off earnings season under the shadow of the Iran war, private credit stress, and AI disruption. Everyone's worried about a drop in FIC trading, or at least that's what seems to be dragging on the shares.
And David Solomon warning about geopolitical angst, and that's our top story this morning. Iran warning it would target ports across the Persian Gulf if its shipping hubs are threatened as President Trump moves ahead with a blockade of Tehran-linked vessels. Trump spoke yesterday after talks with Iran broke down.
I don't care if they come back or not. If they don't come back, I'm fine.
That's safe.
Oil prices are back above $100 a barrel. Gas prices here holding steady at an average $4.13 a gallon. The blockade begins without the help of a key overseas ally. I'm Vicky Barker in London, just in case Donald Trump was wondering.
We're not supporting blockade.
British Prime Minister Keir Starmer telling BBC Radio he opposes any measures which keep the Strait of Hormuz closed to navigation.
That means that oil and gas is not getting to market. That means the price is going up. That means everybody listening to this is facing higher energy bill.
Pope Leo says he has no fear after President Trump attacked his anti-war stance.
I know how difficult it is to forgive. However, as conflicts continue to multiply throughout the world, we cannot add resentment upon resentment, generation after generation.
The American-born Pope speaking in Algeria, the president has posted images apparently generated by AI depicting him as a Jesus-like figure in a long white robe. In one, he places a hand on the forehead of a sick man. Democrat Eric Swalwell has suspended his bid for California governor amid sex assault out. Opinions?
That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets. Newsmakers and market movers. This is the Pulse.
Good morning. Welcome to the Pulse. I'm Greg Johnson. I'm in London. Let's talk about what's happening in the energy story, because that's absolutely front and center right now. So oil prices are up. Gas prices are certainly up here in Europe. The American President Donald Trump vowing to begin a full naval blockade of the Straits of Hormuz later today, 3 p.m. UK time. He's threatening to basically retaliate in the event as well of Iranian resistance. The move would hit nearly 2 million barrels a day of Iranian crude, which has over the last few weeks actually been flowing out of the Gulf, while others have been limited. The announcement, of course, came hours after Washington and Tehran failed to reach a deal during those talks in Pakistan.
I don't care if they come back or not. If they don't come back, I'm fine. Their military is gone. Their missiles are largely depleted. The manufacturing capability for missiles and drones is largely defeated.
President Trump, Dana Kresh, Bloomberg's UAE Bureau Chief, joining us now. Dana, thank you very much indeed for joining us. So we've got not one but two blockades now of the Straits of Hormuz. What do we know about how the US blockade is actually how it's going to operate?
Yes, good morning. So we saw the U.S. military saying that they will be implementing this blockade at 10 a.m. ET, that's around 6:30 p.m. Tehran time, and prevent all maritime traffic from exiting or entering Iranian ports. They said they will not impede such vessels if they are going to and from non-Iranian ports. Of course, that means Gulf ports. And this is an effective blockade in selling Iranian oil. This is the lifeline of the Iranian regime. And this lifeline has been active and open since the start of the war. And to see an impact on the Iranian regime, an impact on their decisions on how to deal with the war, we're going to need this blockade to be about weeks, not just days. And all of this is yet not clear how this will play out. And now we see the head of the Iranian negotiating team who was in Pakistan negotiating with J.D. Vance, the U.S. Vice President, writing on X that now addressing Americans and saying now we will see what the price of gas will be at the pumping station. So, the reaction from the Iranians, they think this is going to be a swift reaction in the market. And we've seen that now with oil prices soaring. We've seen it in gas oil futures too. And so, but the thing is that the president has made so many threats and there was so many deadlines before, and sometimes we see changes in that. But what we need to watch out for is how the U.S. will be implementing this, how this will impact traffic through Hormuz. We've seen the Iranians making all threats today about if the security of their own ports is threatened, then no port on the Persian Gulf, and that's of course suggesting all of the Gulf ports, includes a lot of these Gulf countries, will be threatened as well, and that if there and Hormuz will be open to either all ships or no ships at all, saying that the blockade is illegal, saying that's piracy from the U.S. president. But the big question here, of course, is if there are any attacks on either side, that is a major violation, of course, of the 2-week ceasefire. And we will see this ceasefire collapse and maybe go back to how the status quo was about a month ago, attacks on Israel, attacks on Gulf countries, and of course, major attacks on Iran from the US and Israel.
Dan, I've heard a lot of people, and there was a lot of chat over the weekend about this, that this is just a pause in the talks, that we will be back, that this is just a negotiating time. What do we know about the status of the talks and whether or not we are going to be returning to a hot war again? Where are we in this process? What are you guys hearing?
This is a very good question, but I think it's interesting to bring up what the Iran foreign ministry spokesperson said over the weekend. He's saying that, we agreed on a few things and we shouldn't expect a deal immediately and that diplomacy is a long way.
Okay, let's see tomorrow. PPI tomorrow morning, 8:30.
Seen that from the US side though. But